In our financial analysis and your accounting lectures, you learn that the asset of a company consists of its equity and its liabilities. What it means is that in the accounting equation, if we add a company's equities to its debts or liabilities, it should be equal to its assets. Now, the need for mezzanine finance arises when developers have to bridge the gap between the cost of a project and the capital available. And here, the capital available would often include the sum of the developer's equity contribution and the amount of debt he has raised for the project. Now, for example, the cost of a property development project is 1 million Ghana cedis. The developer has 200,000 Ghana cedis as equity, and the bank is willing to lend at a 70% loan to value ratio. That is, the bank is willing to grant him 700,000 Ghana cedis. Altogether, the capital available for this project is 900,000 Ghana cedis, which is the sum of the developer's 200,000 and the 700,000 the bank is willing to lend. You would observe that there is a difference between the 1 million Ghana cedis cost of the project and the 900,000 capital available. This is a gap of 100,000 to be financed. Now, in this case, the developer's equity only fills a part of this gap. Therefore, to fill the remaining gap, it is often the case that the developer would exploit the higher risk mezzanine finance market, either because he cannot bridge the gap or because for tax or accounting reasons he prefers to take on more debt. So how would we define mezzanine finance formally? We would say that mezzanine finance is individual project loan finance which occupies an intermediate position between pure debt and pure equity. So when we studied capital structure theories at the beginning of this semester, we learned that equity is more expensive than debt because equity stock comes with greater risk as per the pecking order theory of capital. Therefore, as an intermediate finance, mezzanine finance ranks after bank loan in servicing the debt but will earn a priority return before the developer's own equity contribution. The same order of priority will apply should the development fail. So let's attempt to illustrate all that I've said in some kind of a diagram. And in here, I have plotted different financial instruments based on their risk and return profiles. So you can see that we have debt here, and debt comes with a lower risk and hence it attracts a lower return. And then this contrasts with common or ordinary shares or equity, which is associated with a higher amount of risk and hence a higher probability of earning a greater risk. The intermediate financial instruments, which are shaded in red, is what we will refer to as mezzanine finance. They occupy an intermediate position between pure debt and pure equity. As there is greater risk associated to the mezzanine finance than the senior debt, a much higher return is therefore required on this slice of the financing package. So the logic behind this is that the provider of the mezzanine finance is really contributing a substitute for equity funding to the development and should therefore receive an equity reward. Mezzanine finance is therefore normally has a second charge on the development. And the issue of a second charge is quite interesting because when we looked at bridging finance, we also learned that there is a type of bridging finance called the second charge bridging finance. What it means is that if if you are a lender and you provide a mezzanine finance, it means that there is a first charge, which is the uh, the lenders who have provided debt to the developer. They have a priority in terms of debt servicing over um, those who have provided mezzanine capital. And so that introduces risk, and hence they expect to earn a higher amount of return for that activity. Yeah, but however, mezzanine finance is not normally available for periods of greater than 3 years and is often used to finance shorter term development loans. If the developer wishes to retain the completed project as an investment, then the mezzanine finance itself will need to be refinanced. This can be done by the use of a holding or investment loan, which is long term lending calculated by reference to evaluation of the completed project. Severe credit restrictions experienced in property market troughs or periods of declines in the real estate cycle have given added importance to this type of finance. The normal source of senior debt for development, which is the banks, they become more reluctant to finance projects at levels of 70% loan to value ratios, leaving a gap between what lenders will provide and what developers and investors require. The collapse of other funding sources, particularly the commercial mortgage backed securities market, especially in the Western world, and the tightening of financial regulation have also given added stimulus to mezzanine finance. Yeah, so this is a little about mezzanine finance. I'm looking forward to designing some case studies for us to look at how it works in reality. And so I want you to watch this video, and if there are any questions, let's post them on the Google Classroom platform, and I will have a look at them and respond accordingly. So I think this um, lecture will bring us to not to an end of the entire lecture series. Next week, I'll be looking at some other forms of finance, like joint ventures, and I think that will bring us to the end of financial instruments for real estate projects. I'm hoping that I will be able to do that next week, and then if there's extra time, then we'll look at solving some problems, or we'll look at some case studies moving forward. Thank you. Bye.